Schwab just did share splits for 20 of its ETFs, of which include one of the ETFs we often talk about here on the channel, SCHD. This means if you do own SCHD, if you look at your account right now, you should see that you now own a lot more shares than you did prior to October 2024. But this comment right here is the topic of today's video. Specifically asking, are ETF splits good for index-based funds, or is this a warning sign? And that's a great question. What exactly does this mean? Should we buy more SCHD, or should we start turning away and going into something else? Now, this channel is all about personal finance, and your comments fuel the future videos. So just like the comment you saw, drop a comment down below. You never know, your comment might be featured on the next video. So before we talk about the good versus a possible warning sign, let's talk about what a split actually is. Now, SCHD just performed a 3-for-1 split. What does that mean exactly? Well, for every one share that you own, Schwab will split to provide you 3 shares. So for an example, let's say you just own 1 share of SCHD. Now before the split, the price of that was right around $85.02. This means your total portfolio of 1 share equals $85.02. Now along comes the split, and that means that you now have 3 shares of SCHD. And because of the split, the price of SCHD also changes since everything is being divided by 3. So due to the split, which means post-split, SCHD would be right around $28.34 per share. Now your portfolio has 3 shares of SCHD at $28.34, which means you have a total of $85.02. See, nothing really changes in a split from a portfolio perspective, at least not right away. More on that a little bit later. But to the question that was asked, is this a good thing that they did this, or is it a possible warning sign? Well, a split does not necessarily mean any warning. It doesn't mean that they're expecting some type of stock market crash coming up, or they're seeing the next recession on the horizon. That doesn't mean anything. Really, the split has nothing to do with that at all. Stock splits for ETFs are typically done for logistical and psychological reasons rather than reflecting changes in its performance or its underlying assets. Now, the key word here, though, is psychological reasons. If you're a new investor, let me ask you a question. Would you be more attracted to an ETF that goes for a price of $485 a share or a price of $24 a share? The answer is obvious. Now, see, typically investors are going to flock to the lower price as long as the fund has good fundamentals and a good growth projection. So it makes the fund more affordable and liquid. It doesn't change the market value of the ETF and potentially has more investor appeal. And that is where the good news could potentially come in when it comes down to if this is good or bad. So if the fund seems more attractive, it could potentially bring in more retail investors, and those retail investors might prefer to buy more whole shares than fractional shares. So they're going to flood into SCHD now that it's only $24, $25, $28 instead of where it was at $80, $85. And this could lead to increased trading volume, which could marginally help liquidity and give us maybe some small returns. But all of this said, here's what separates the rookies from the pros in understanding how the ETF is trending. And this is where we need to do some charting in order to do that. So let's hop over to Seeking Alpha and take a look. So here we are over on Seeking Alpha. By the way, they are offering my viewers a discount. I'll include a link down in the description if you want to get all of the things that you're watching me do today, and you want to do it for yourself, feel free to take advantage of that. But here we are on SCHD. Now, as of the recording of this video, you can see it's $28. We are post-split, so that's why it's so cheap at the moment. But remember, it's all relative. So let's talk about the pro version of this, not the rookie version. The rookie version is going to say, hey, this seems cheap. So because it's cheap, it might rise over time. And because it might rise over time, I stand to make thousands of dollars. In fact, I got a funny comment just the other day of somebody saying, hey, I'm getting in on this particular stock because it's so cheap and I bet it's going to run up. Well, you look at the fundamentals of that stock, it was complete garbage. And we've got to be careful about that, even with an ETF. So here's what we're going to take a look at. You can see SCHD right here compared to the S&P 500. Now you can see as the time frame of 1 year is selected, SCHD is actually underperforming the S&P 500, which means you could get an ETF like VOO, SPY, things like that to track the S&P 500 and actually end up getting more of a return, at least in this last year. But hold on, put your lap bars down and buckle up for this ride because it's about to get interesting. The first thing I want to point out is that remember that SCHD is a dividend-paying ETF. So in order to truly compare apples to apples for actual return, we need to change something, and that is right here in the metrics. I'm going to change this right here from price return, which is not accurate. We're going to X that out, and we are going to come down here to performance and select total return. And the reason for that is we are going to reflect that total return, which includes all the dividends reinvested or all the dividends paid out in SCHD, compared apples to the S&P 500. Now let's take a look so we have a better update. Now, things still aren't looking as good, right? So in the 1 year, at least the last year, SCHD underperforming the S&P 500. But here's where the pros really kind of weigh in. You got to look at your portfolio. You got to look at your overall strategy and say to yourself, do I like the idea of where this is heading? Do I like the idea of balancing SCHD with maybe something else? Maybe it's a technology fund and I need a little bit of balance for when the headwinds come. What are headwinds? You know, stock market dips, crashes, etc. We got to somehow balance that out. A great example of that is 2022. Interest rates were going up. Everybody was freaking out. Everybody was fearful, and the stock market was going down. I think it lost right around 17 to 18% in 2022. So comparatively, if you look at SCHD, could it help with some of those headwinds? Those are the things that you need to know as a pro. You don't really care about the split. You don't really care about the price. You care about the future potential. And this is where it gets interesting. Let's take a look at the 5-year. If I click right here where it says 5, now look, it's looking a little bit different. 87% versus 95%. Even better yet, I'm going to go to the 10-year chart. This is where things get weird. So you look at the 1 year, you might be like, well, SCHD is kind of garbage, right? You look at the 10-year comparatively to the S&P 500, and it tells you a different story. Now, why is that? Look right here what happened. As the S&P 500 is struggling a little bit because we have the interest rate hikes and some companies having some struggles, etc., it's having a little bit of a dip here, right here in this zone. But you can see that even though SCHD is also having some issues, it doesn't hurt as bad because it has a lot of stocks that make up the ETF that are more consumer staples, defensive, and things like that. Those are the things that typically thrive or at least maintain their strength during these periods of downturn. And that's what we need to really analyze when it comes down to, is this a good idea for your portfolio or not? It may be, it may not be, but the point of the matter is, and to the question that was asked, SCHD is not splitting because it's trying to warn you of something. There's nothing sinister going on, and there's nothing that you would necessarily need to worry about. What you need to worry about is doing your pro research. Make sure that you feel good that this could make up your portfolio in a good way. I can't give you direct financial advice, but only you can do that. And if you do it the right way, you might be looking pretty good in the future. Well, what video are we going to talk about next? Why don't you comment down below and let me know? And until then, check out this video, and we'll see you on the next video.